Hello, Baker Finance students. We are now in week 5, and I hope everybody had a good weekend. We'll be wrapping up this week and starting week 5 in chapters 12 and 13. And again, this week you have a brief form discussion. I want you to talk a little bit about your company's dividend policy. You know, maybe some of them don't, for your company, it doesn't pay a dividend, but most companies do pay dividends. You know, does it follow any specific dividend theory? As outlined in your textbook, you know, is it a stable dividend policy, or does it have a growth policy, or what payout does it have relative to its dividends? You know, you can find a plowback or payout ratio. What percentage of its earnings does it pay out in the form of a dividend? Stable companies like utilities, well-established companies like GE may pay out maybe 50% of their dividend, have a very high dividend. Others that are growing companies pay very little in dividends. They hope to get more capital gains for the investor. But anyway, do a little bit of research. Just make sure to make your post by Friday, and then follow up with a response to another student by Sunday at midnight. Now, also, the other big thing to do this week is the equivalent annual cost paper. I put an example out there, although it's from a different textbook. It's still the same concept, what I want you to follow from your paper. But essentially, you're going to be picking something. It could be like a hot water heater versus the automatic. I think they have those instant hot water heaters today that don't take up much space. So in making a comparison between the two explicitly, based on equivalent annual cost, what would be the better option? But then again, you can also take into implicit considerations when making your choice. Even though one may be more expensive, you know, this is going to make you happier, or you feel you're just better off with this particular piece of equipment, hot water machine, whatever it would be, you know, down the road. So little notes about chapter 12 and 13. Chapter 12 starts off, you know, the concept that with any business model there's risk. You look at the news today and everything from McDonald's going up against Taco Bell, and whether Tesla, you know, their sales strategy. So there's no guarantees in business. In fact, you could probably, if you listen to the advice of the many CEOs, they'd probably tell you the one thing you can't control is revenues. What you can control is cost, and that's why a lot of times CEOs tend to focus more on costs than they do the revenues a lot of time. But you know, just we looked at last week, there's the exciting things about projects that try to generate more revenues. I had the nice time to go down to Big Cedar with my wife this weekend, and you can see it was a place just a little bit above northern Arkansas, southern Missouri, but they're constantly reinventing themselves. And I think that what makes their hotel and their cabins so successful is they figure out a right model. And albeit, you know, an expensive place to stay, they seem to be doing quite well. So at least for that venture of his business, or the Bass Pro Shops, is doing quite well. So anyway, back to the chapter 12. You know, it's the first start off, you know, with that concept of the break-even analysis. How many units do I have to sell just to break even? Because the firm usually has to start off with some level of fixed cost. And another variable that you're going to look at is called the degree of operating leverage. And this ties into the concept of fixed cost. So the higher my fixed cost, the more units I'm going to have to sell to break even. But likely after I break even, the profit margin ratio is going to be greater if I have high fixed cost. If I have low fixed cost, I can break even a lot sooner, but the profit margin may be a little bit less for each unit after I break even. And then finally, we look at the degree of financial leverage. This is the use of debt. Debt can be a good thing because we can use it to help lower our tax liability. It can lower the overall weighted average cost of capital. But the problem is, if our company does not do well, the firm does not do well, we still got to pay back that debt. It's not like stock that it's not requiring a payment. So if you financially leverage yourself, it can have a big negative impact on earnings per share. But with fewer shareholders and more use of debt, it can definitely benefit those existing shareholders if things go well. And the last thing they kind of wrap up with this chapter is the kind of the realistic expectations about taking on more debt. That if we see a greater use of debt, the market's going to recognize that and actually require a higher rate of return on debt. So there's kind of a limit to how much debt we can use. And it's kind of finding out that right market mix of both debt and equity to try to maximize the value to the shareholder. Finally, in chapter 13, just brief chapter, is going to go a little bit about the different dividend theories. It's going to go about how dividends are paid out. Essentially, once it hits X dividend date on a stock, If you buy it on that day or after, you're not entitled to that dividend. So it's going to go over a little bit of the accounting process. And you're also going to visit some things about stock splits and stock repurchases. So again, just a brief chapter, but do send me an email if you have any questions. But I want you to have a great week, and I'll talk to you online. Take care.